Hi everyone, good to talk with you again. It was just last night that we finished our last lecture on chapters 21, 22, and 23. As you may remember, we did run into a time crunch towards the end. I did keep you longer than anticipated. And so I mentioned that we would bulletin board these practice exercises, one for the sake of time, two to give me an opportunity to put this together to show you in a more constructive format. So as you can see, our Chapter 22 exercise was to compute the first 6 months of a loan amortization schedule with a principal balance of $60,000, an interest rate of 10%, and a payment period of 3 years, 36 months. So you're not provided a very good formula for calculating this. So what I'm going to do is show you this is the way that this would be done in the real world, maybe not from an academic standpoint, but in the real world, this is how this is calculated. And in the real world, we use Excel. So I'm going to pop this up here. And what I want you to see first is simply what I want you to do is go into Excel as you're watching this and follow along with me. So you're going to enter your major headings. So we know what our loan amount is. So we write in loan amount and then $60,000. We know our interest rate. So we write interest rate. That's another heading. We know that interest rate is 10%. So we put 10% here. We know what our terms are. And we're calculating what the payment is per month. We know that the term is for 36 months. And so we're going to put that 36 here. And we're going to calculate for our payment. So on your Excel, as you're typing this in, this field is going to be blank. But what you are going to type in is the formula, which I'm going to show you now. Your formula that you're going to want to use, and you can use this in your assignment this week, is going to be equals and then round in all caps. And we'll put round in there because we want to be able to round the number up. And we're going to designate where. It's going to be 2 decimal points, which is what this 2 is here at the end. So it equals round and then parenthesis, and what we're calculating for is the payment. So we want a payment formula in here, and the payment formula is PMT, all caps, another parenthesis because we're going to calculate it, and then you're going to see this dollar sign. If you're not familiar with Excel, when you put a dollar sign in your formula, it keeps your field static, meaning it won't move it forward, backwards, up or down. It's going to keep it the same. And here, we're going to place a dollar sign and then B and then a dollar sign 2, and that is for B2. B2 is our interest rate. Our interest rate we're going to divide by 12 because we want to calculate what we're doing per month. So our interest rate divided by 12. Our next category is dollar sign B, dollar sign 3, so that we keep B3, our months, 36. And then we have what our loan amount is. It's going to be a negative dollar sign B, dollar sign 1 here. And then we are going to have a comma and then a 0. And that 0 is there because that is the field for a future value. We're not predicting a future value here, so that's going to be 0. We're going to end our parentheses. We're going to have a comma. And then this 2 represents how many decimal points that we want to round up to. So we want 2 decimal points. We don't want it going way out here. And then we end the parenthesis. And when you put that formula in, it's going to give you your payment amount of $1936.03. You can rewind this and play it again. This is going to help you in calculating this activity. Okay, the next that we had was chapter 23. So let's walk through chapter 23 a little bit here. Okay, so here in chapter 23, we're looking at the north side clinic and the south side clinic, and we're looking at purchase versus lease. And there's some information I think that's provided in your text. Actually, I know there is. I'll get to that. So in chapter 23, excuse me. On page 264, we have the information that's provided. It says, for both north side and south side, assume that the equipment's cost will be $50,000. We see that right here, our equipment costs $50,000 when we're purchasing it. Likewise, assume for both north side and south side that if the equipment is leased, the lease amount will be $11,000. We'll see that when we get to the lease part. And so here's where some of your assumptions are made. We need to make the assumptions about depreciation expense for the purchased equipment. So they're going to use straight line depreciation in the amount of $10,000 for years 2 through 4. And we see that depreciation expense here. And they're using, for the initial year of acquisition, which is year 0, we assume a half-year method of depreciation, whereby the amount will be 1/2 of $10,000 or $5,000. And we will see that as well. And we'll further assume that the purchased equipment will be sold for its salvage value of 10% or $5,000 on the first day of year 5. And that the taxes are going, the federal and state income tax are going to be assumed to be a total of 25%. And so what we see here is we have those assumptions built into this table. This is 25% of that for that tax savings. This is our purchase, and we're going to see that tax savings across, and it's our end of life, our salvage value at the end of the term of that depreciation schedule is $5,000. And so you're going to be able to deduct that at $5,000 amount at that point. So we have a net cash flow, or it's really it's really an interesting term. It's not really cash. It's more net income impact, but we won't split hairs over that. When we get to the cost of leasing, our assumption of $11,000 is here. Again, we have 25%, and the impact on our net cash in terms of the tax savings. So you're not, it's not impacting cash flow, but it is impacting the financial statements as a, in what is allowable as taxable income. I mean, depreciation is not cash, is my point. So it's not a cash anything, but it is going to impact the income statement and what the taxable amount is. All right, so on our net cash flow effect example, we have the $5,000 in year 0 for the half-life depreciation, and then our $10,000 for the remaining years. On our equipment purchase of $50,000, this is for the South Side Clinic, which is not for profit, so there are no depreciation tax savings here. Just the end-of-life salvage of $5,000. We see that on our equipment rental, what we're paying, what the lease savings are, which there are none, and then our impact of $11,000 to the bottom line. So what does that all mean? Well, we're going to factor that in. You're going to need to find your table, and I'm not sure that that was presented anywhere. I'm not sure that that was presented anywhere, but it is found on page 141. And you would look there, you look at 8%, and that's where you're going to find your present value factor of 0.926. I just rounded up. It's year 1 at 8% on page 141, and then you can do the calculation from there. Further, the same applies here. You're going to find your present value factor of 0.681 in the same place on page 141, and you can finish the calculation there. I will say that this is not, in the real world, in my 30 years, I've never sat down with anybody and done a present value calculation. It's usually other factors. What's going on operationally? What is the cash flow like? Are there going to have to be personal guarantor signers, or is it going to be based on the company's financials? It goes into lease versus purchase and those type of things. There's a whole lot of other variables that go into the decision-making process between purchasing or leasing, and it's, in my experience, it hasn't been this calculation. So, but good to know where to find the material in your text to help you calculate it through. So I hope this has been helpful. If you have any remaining questions, please feel free to email me, and I look forward to seeing you in the discussion board and next Tuesday. All right, thank you very much.